Hello folks, welcome to our channel Intel.Stream. In today's video, we are going to talk about inflation and how does it impact your savings. Have you ever noticed that what you could buy for $1 a few years ago now costs $2? That's inflation at work, slowly but surely decreasing the purchasing power of your money. Today, we'll dissect what inflation is, how it affects your finances, and most importantly, how you can protect yourself from its effects. By the end of this video, you'll be armed with the knowledge to navigate an inflationary world. Let's dive in. What is inflation? Inflation is, in its simplest terms, the rate at which the general level of prices for goods and services rises, thereby decreasing the purchasing power of your money. Picture this. A cup of coffee that cost $1 10 years ago might cost $2 today. That's inflation, making your dollar worth less over time. But there are different types of inflation, each driven by different factors. 1. Demand pull. Inflation, which occurs when demand for goods and services exceeds supply, pushing prices up. 2. Cost push. Inflation. This happens when the costs of production rise, think higher wages or raw material prices, forcing companies to increase prices. 3. Built-in inflation, which is linked to expectations. If people expect prices to keep rising, they demand higher wages, which then leads to higher prices, creating a cycle. Real-life example. Think about the cost of living. Groceries, housing, and healthcare all cost more today than they did a decade ago. That's inflation in action. To measure inflation, economists use various indicators, with the most common being the Consumer Price Index, CPI. The CPI tracks the prices of a basket of goods and services that a typical household buys, such as food, clothing, and transportation. When the prices of these items rise, the CPI goes up, signaling inflation. But the CPI isn't the only measure. First reason is Producer Price Index, PPI, that looks at the prices producers receive for their goods, which can be an early indicator of inflation. Number 2 is core inflation, which excludes volatile items like food and energy, providing a clearer view of long-term trends. Let me show you a quick example. Imagine a chart showing the CPI over the last 20 years. You'll notice a steady upward trend. Prices generally rise over time. This steady rise is the creeping inflation that eats away at your purchasing power. Now, let's delve into what causes inflation. First up is demand pull, inflation. This occurs when the demand for goods and services outpaces supply. For example, during an economic boom, consumers may spend more, leading to higher demand for products. If businesses can't keep up with this demand, they raise prices, and voila, prices inflate. Next is cost push inflation. This happens when the cost of production increases. If wages rise or the prices of raw materials like oil go up, companies may pass those costs onto consumers in the form of higher prices. Finally, built-in inflation stems from expectations. If workers expect prices to rise, they demand higher wages to keep up with the cost of living. Employers then raise prices to cover the higher wage costs, and a cycle begins. This is often called the wage price spiral. These factors combine to create the inflation we experience daily, making it crucial to understand what's driving the changes in the cost of living. Inflation doesn't just increase prices, it directly affects your financial health. Let's start with purchasing power. As prices rise, each dollar you have buys less. What you could purchase with $100 last year might require $105 this year. Over time, this erodes the value of your money if your income doesn't keep pace with inflation. Next, consider your savings. You're earning 1% interest on your savings account, but inflation is at 3%. You're effectively losing money. The real value of your savings decreases because your money doesn't grow fast enough to keep up with rising prices. On the flip side, investments can help you combat inflation. Stocks, real estate, and other assets have historically outpaced inflation, meaning your money grows faster than prices rise. That's why investing is crucial. But inflation isn't all bad. If you have debt, inflation can actually work in your favor. As prices and wages rise, the relative burden of your fixed-rate debt diminishes. Essentially, you're paying back loans with money that's worth less than when you borrowed it. Understanding these impacts allows you to make informed financial decisions, whether you're saving, investing, or borrowing. Now, let's talk about the inflation and the economy. Inflation doesn't just affect individuals, it has significant implications for the entire economy. Moderate inflation is often seen as a sign of a healthy economy. It encourages spending and investment because people expect prices to rise in the future, so they buy now rather than later. However, high inflation can lead to uncertainty. When prices rise too quickly, consumers and businesses may struggle to keep up, leading to decreased spending and economic slowdown. This is why central banks, like the Federal Reserve, aim for a modest inflation rate, typically around 2%. On the extreme end, hyperinflation can devastate an economy. Look at historical examples like Zimbabwe or Venezuela, where inflation spiraled out of control, making money virtually worthless. Conversely, deflation, where prices decrease, might sound good, but it can be equally dangerous. When people expect prices to fall, they delay spending, leading to decreased demand, lower production, and economic stagnation. Japan has struggled with this issue for decades. Central banks play a crucial role in controlling inflation. By adjusting interest rates and using other monetary tools, they try to keep inflation in check while supporting economic growth. It's a delicate balance. Now that we understand inflation, let's talk about how you can protect your wealth. First, consider inflation-hedged assets. Investments like real estate, commodities, and treasury inflation-protected securities, TIPS, can help shield your portfolio from inflation. Real estate tends to appreciate in value over time, while commodities like gold often rise with inflation. Next, focus on diversification. A well-diversified portfolio, including stocks, bonds, and alternative investments, can help mitigate the risks of inflation. Stocks, in particular, have historically provided returns that outpace inflation over the long term. Finally, maintain a long-term perspective. Inflation can vary year to year, but over decades, having a solid investment strategy can help you stay ahead. The key is not to panic during periods of high inflation, but to ensure your financial plan is resilient enough to weather different economic conditions. In summary, inflation is an economic reality that impacts everyone. It reduces purchasing power, affects savings and investments, and can even benefit borrowers. But by understanding how inflation works and taking steps to protect your wealth, you can stay ahead of the game. If you found this video helpful, make sure to give it a thumbs up and subscribe to my channel for more financial insights, and leave a comment below. How are you planning to protect your money from inflation? Thank you for watching. I am Ankit from Intel.Stream, and I look forward to seeing you in the next video, where we'll explore more strategies to safeguard your financial future. Until then, keep your finances healthy and thriving. Thank you.